Hello, everybody. It is Michael here from My Retirement Trading, and today I had the pleasure of interviewing David Dziekanski, CEO and founder of Quantify Funds, about their ticker BTGD. And it was a great interview, and I learned a lot more about gold and Bitcoin. And without further ado, let's get into it.
The last 10 years, every time Bitcoin has been down, at least 15% or greater, how has gold performed? And it's ranged from, gold being down 4% to being up 14%. But it's very uncorrelated and it's very close to zero to slightly positive. And so this gives you this amazing vehicle that's 200% total exposure. But again, when there's volatility in your most volatile asset, which is Bitcoin, that's when gold actually seems to not have a lot of volatility and not have a lot of correlation to Bitcoin, which is why we think there's just this magic thing that happens when you're pairing these two vehicles.
Hello, everybody. It is Michael from My Retirement Trading, and today we have a very special guest. But before I get into this, I must state that none of this is financial advice or a recommendation, and it is for entertainment purposes only. So without further ado, let's welcome our special guest, CEO and founder of Quantify Funds, David Dziekanski. Welcome to the channel.
Thanks, Michael. Thank you so much for having us on. We really appreciate it, and it's really great to reconnect. We initially met at the Blossom Conference in New York, and it's amazing to see the community they're fostering and all the amazing information that you guys are creating within this community. So I'm very excited to be here today.
So, David, tell us about your background and how you founded Quantify Funds.
Yeah, so I've been in the asset management industry for a long time. By trade, I was a math, finance, and econ triple major, master's in quantitative finance. My first foray into the ETF space started in 2007. I was a portfolio manager for an internal asset management group that had what grew to 6,000 financial advisors that could use us as the internal offering. We managed about $1.8 billion of ETF managed portfolios, which, I think before you start building ETFs, actually managing real live assets using ETFs, I think is really important to really understand what it feels like to be the. From there, I was the fourth employee and partner at Tidal Financial Group, along with Mike Venuto and crew there. As I mentioned, was a portfolio manager and also head of new product development for quite some time. I did that for about 11 years, and I've always had a dream of offering true hedge fund-like strategies in the ETF wrapper, and that's one of the reasons why I founded Quantify Funds just a little bit over a year ago at this point. The idea is bringing hedge fund quality-like offerings to the ETF wrapper. The ETF wrapper is the best investment wrapper in the world. It is the most tax-advantaged wrapper in the entire world, and it is also the easiest to trade. And especially once you start going into the alternative space, we think that's really important. Because what is the point of having an alternative in your portfolio if you can't rebalance it? So you could find the greatest hedge fund manager in the world, but if you can't trim their portfolio after they do really well or have a really good return and reallocate to the rest of your portfolio, you're missing half the battle. Because asset allocation isn't just about what you own, how much you own, but it's also how you rebalance between them. And so that's why we've been huge fans of the ETF wrapper for me personally, my entire career. We built Quantify Funds to offer hedge fund-like tools in the ETF wrapper that allow you to get hedge fund-like diversification, leverage in your portfolio with a vehicle that you can buy and hold, and you don't have to necessarily trade like a day trader, but still gives you the same skill set and same tools at very similar interest rates that you get to compete with a lot of the really big boys.
So today we're going to talk about BTGD. That's your Bitcoin and gold fund. Can you go into that and tell everybody about that?
Yeah, of course. So you can find information on this on quantifyfunds.com, but we launched mid-October last year, October 15th, the stacked 100% Bitcoin and 100% gold ETF, ticker BTGD. You don't really have to choose between which you think is the better store of value. You get to own both and rebalance between the two. And by doing it in the stacked format, you're not actually sacrificing one for the other. You get a full allocation to both. So $1 in BTGD gives you every single day $1 of exposure in gold and $1 of exposure in Bitcoin. We like to call it addition without subtraction. A lot of the times in the alternative space, one of the hardest things to do as an allocator is decide, what am I going to sell to allocate to this vehicle, right? And so you might be a growth investor or an aggressive growth investor, and Bitcoin's volatility profile might make some sense to you, but you might think, gold might not actually move enough for it to warrant me selling equities. This is a way to layer it in on top. So the best institutions in the world all use some form of leverage. That doesn't mean you take more of what you already have and just leverage it to no end. But if you use that leverage to provide diversification to the bigger assets in your portfolio, it can be a really powerful tool. So if you go back to, Finance 101, obviously you can look at a portfolio in terms of like, what is your mix between risk and risk off assets, stocks and bonds? But alternatively, once you've found that optimal portfolio, you can actually add a little bit of leverage and get much better returns. And all the biggest institutions in the world, whether it's endowments, hedge funds, they all use a little bit of leverage, and they use it as a tool. They don't overuse it, but it's definitely a tool that when used intelligently can help your returns. Oftentimes it's easier to actually try to drive a little bit of alpha, not from trying to be the greatest stock picker in the world, but from just portfolio construction. So BTGD, which is a 200% total exposure vehicle, as you alluded to, is a buy and hold leverage vehicle. We don't have that disclosure in it that says just intended for daily use. So this is something you can use in an asset allocation model, and it allows you to get some overall portfolio level margin without having to worry about rebalancing the portfolio every day. There's actually nothing wrong with leverage ETFs. They're just not a natural form of leverage, which means to achieve a natural form of leverage, you have to rebalance a traditional leverage ETF, 3-4 times a week to get to your intended target. But because we have two assets in our portfolio here that are very diversified, Bitcoin and gold move independently. They have about a 4% correlation over the last 10 years. That allows us to take on some of that responsibility of those regular rebalancings and do it within the ETF. So especially on days where your two assets move in opposite directions, like that's where kind of the magic happens, and we get to rebalance within the portfolio, and that's less onus on you, the allocator, to have that have to perform that rebalance so frequently, and that's what creates this magical vehicle that allows you to have a 200% total exposure ETF that doesn't have a ton of volatility and that can actually be bought and held.
So, as you said, this is a buy and hold product, and on your website it says stacked Bitcoin and gold ETF. Okay, and also it's a hedge against inflation. The product is for that. So, how has the performance been of this fund since it came out?
Yep. So we launched mid-October last year. We're up about 115% since we've launched. Most importantly, what I'm most excited about is not with a ton of volatility. So if you go on the BTGD page on Quantify Funds, we have a couple of interesting papers there. The first one I'll reference is the case for Bitcoin and gold. And on page 1, there's a risk return chart there that just shows you, how much returns did it get on an annualized basis and what is the standard deviation of these funds. And it shows you gold ETFs, 2 times gold ETFs, Bitcoin ETFs, 2 times Bitcoin ETFs. What you'll see is we have significantly more return than obviously just Bitcoin or just gold alone, but we don't have significantly more risk. So we actually only have a couple % more risk than just owning IBIT by itself, even though we're a 200% exposed vehicle. And that's because of the correlation benefits between Bitcoin and gold. So for example, over the last 6 months, if Bitcoin was down 10% on average, we were down about like 8.5%, 9%, a little bit less than Bitcoin. And when Bitcoin's up 10%, we're up 115 to 130%, depending on the different time periods over the last 1, 3, 6 year to date and 12 months. But that allows you to see that, the leverage is working in your favor, where you're getting a little bit more volatility than Bitcoin on the upside. And as long as the correlation holds, less volatility than just Bitcoin on the downside. And we were very, very cautious as to what assets we wanted to choose in this stack to really represent this true store of value. As you alluded to, an inflation hedge, a currency debasement hedge. These are assets that the government can't print, that have true scarcity profiles. So Bitcoin mines at 0.86% per year, meaning there's less than 1% new supply of Bitcoin in the world every single year. Gold mines at 1.75% per year. So that means there's about less than 1.75% new gold introduced into the world each year. Table this for a little bit later on in the show. Central banks already buy 1/3 of all gold that's mined, right? So they're not even allowing it to get to the end consumer, the allocator. But paper currencies print at 7 to 9% per year, right? And that's the mismatch that you're taking advantage here, is that every year, every day, there's more dollars chasing fewer Bitcoin and gold. And that's why we view these two as like the premier scarcity pairings to use as like a currency debasement hedge. Obviously, there's lots of precious metals, there's lots of crypto out there, and there's lots of reasons to own them for different purposes. But in the purpose of having a store value trade that has pure scarcity, these we think are the two best ones. And if we look at, for example, some of the other cryptocurrencies like Ethereum and Solana, we think there's lots of value to be had in those. Those are technology platforms. That is a beta portion of your portfolio. That, those are very similar to your equity allocations. I think you should own some of that, but that is not necessarily this currency debasement store value trade. Similarly to like silver or even like copper, et cetera, these are things that are used in technology, which is great. That also makes it more tied to the performance of the economy. If people are trading silver based on how much silver is used in electric cars and your phone, if we buy less cars and less phones, there'll be less demand for silver. Whereas like gold and Bitcoin, the majority of their value is coming just from their store value and scarcity.
So I heard you say that when Bitcoin goes up, that this fund performs very well when it goes up, as far as the Bitcoin part of it. You said something about like went up 100%.
So we haven't finalized this paper yet, but over 1 year to date, 6 months, 3 months, and 1 month basis, when Bitcoin's up, we've had higher returns than Bitcoin because the gold has been additive to the stack. And when Bitcoin's been down, we've had slightly less downside than just Bitcoin because gold is actually protected a little bit during that time period. Obviously, it's not going to happen like that in every single time period, but over the long run, we do anticipate that to be the relationship between these two assets. And it's not magic. It's just the benefit and potential of taking two uncorrelated assets and methodically rebalancing between the two. It could be stocks and bonds. It could be Bitcoin and gold. There's lots of different ways to do this. And, we're not new to invent this concept of these two assets in an ETF or a mutual fund. The first that comes to mind is PIMCO Stock Plus. They've been around since the 90s. They're a fund that is 100% the S&P and 100% their bond portfolio. And for them, the idea was, well, same thing. You choose two assets that on the downside will have strong diversification benefits, but maybe you can even get the benefits of both on the upside. So on a day-to-day basis, on a week-to-week, month-to-month, year-to-year basis for BTGD, you can expect us to get the return of Bitcoin's price plus gold's price minus a very cost-effective form of financing. So right now we get all of our leverage through the futures and options markets. You can consider it about a 4.25% cost of financing. So if you look at a 6-month period and Bitcoin's up 20 and gold's up 10, we'll be up 30 minus that cost of financing, which, if it's, for example, like a 3-month period, it'll be 1/4 of 4.2%. So a little over 1% financing fee per quarter. And so it's the alternative to you actually going out there and getting margin on your portfolio and then having to buy more of these underlying assets and dealing with that margin and then having to be responsible to rebalance between those two.
In an up market, this fund should perform very well as far as up market, as far as Bitcoin. And how would it perform like in a down market? You said that it won't be as bad as the actual Bitcoin going down.
No, it hasn't. I would say it has not been as bad. The investment period will be unique. We expect over a long period of time that we can achieve less downside than just Bitcoin alone. But, we are still fully exposed to Bitcoin. So if Bitcoin is down 20%, you should fully expect our fund to be down in the 17 to 20% range. It's not going to magically make all the volatility and the downside disappear, but it'll just help you compound even faster. If one asset's down 20 and you're down 17, and then you're compounding faster on the upside, you can see that's why, if you look at our fact sheet, that's why we've been able to outpace significantly since our inception, both the price of Bitcoin and the price of gold. And you can just look at our numbers on our fact sheet since inception and see, the overall return has essentially been the price of Bitcoin plus the price of gold minus that cost of financing, outpacing both underlying assets individually.
So if gold was to go down a whole lot, say like 20%, what would happen to this fund?
Similarly to Bitcoin, we're 100% exposed to gold, so you will see a drawdown on gold as well. We saw a drawdown in gold about 2 weeks ago. We had a period where gold was up, I think, 10 trading days in a row by a significant amount, which almost never occurs. And we saw a little bit of a reset from that. But the beauty of this fund is that during that period, gold was climbing, Bitcoin was falling. We were trimming gold, adding to Bitcoin. That Monday happened where gold was down over 5%. Bitcoin was up. So we had just been buying Bitcoin, and now gold is down. Bitcoin's up, so now we're trimming our Bitcoin and buying gold. So this volatility actually helps us, and you can see why the risk-adjusted returns that we have can be far superior to just owning these individual assets on their own. Going back to that paper I referenced initially, the case for Bitcoin and gold, on the third chart, I show what gold does in every 15% or greater drawdown in Bitcoin. So over the last 10 years, every time Bitcoin has been down at least 15% or greater, how has gold performed? And it's ranged from, gold being down 4% to being up 14%. But it's very uncorrelated, and it's very close to zero to slightly positive returns. And so this gives you this amazing vehicle that's 200% total exposure. But again, when there's volatility in your most volatile asset, which is Bitcoin, that's when gold actually seems to not have a lot of volatility and not have a lot of correlation to Bitcoin, which is why we think there's just this magic thing that happens when you're pairing these two vehicles.
So you this is an actively managed fund, and you said you have to rebalance it how many times a week usually?
Yeah, so we rebalance it on drift, usually right now between a 3 and 5% drift in the portfolio, or if we get creates. So the idea is to let it run a little bit, but then capture that randomness between it running and use it as an opportunity to rebalance between the two. And as I've alluded to, that gives you such an amazing Sharpe ratio. And Sharpe ratio is just a fancy finance term for risk-adjusted returns. So it's great to try to get a lot of returns. We were up over 115% in our first year. But it's also at what cost or at how much risk or volatility did you need to achieve those returns? And that's where a term like Sharpe ratio comes in. It adjusts your returns for how much for each unit of risk taken. And that's where we really shine versus, yes, you can find some bizarro leverage ETFs that are up over 100% a year, but they're going to kind of be like this and give you a heart attack to own, and not intended for daily use. But we did it with as pretty much as minimal volatility as we could to be able to get to that 150% return mark. And I think the thing you do have to believe in here is you have to believe in the case for both Bitcoin and gold long term. The beauty is gold doesn't have to outperform your equities. Gold doesn't have to outperform your Bitcoin, right? Gold just has to outperform this cost of financing for it to be additive. And I think a lot of people struggle with an asset class like gold because they're like, but if equity markets are booming, am I not going to make any money? This alleviates that stress because you're just layering gold on top of your Bitcoin. So you're kind of just hiding it within that position, and you don't need to sell more equities to allocate to it. And that's where, on the onset of the call, I said, it's kind of like addition without subtraction. You don't need to sell more equities to add your gold on top. You can actually just reposition, for example, your Bitcoin into this Bitcoin and gold vehicle. The last paper I'd love to reference is a more recent paper we wrote called the Case for Gold Now, or Why Gold Now. And really what it looks at is two things: is how much gold does the institutional world own? How much gold does the central bank, the conglomerate of global central banks own? And so first we'll talk about the central bank side, which is charts, I believe, 2 and 3 on that paper. You can see in the 90s, at one point, central bank were net sellers of gold on an annual basis. And you can see further on that fourth chart, at a certain point, gold was 70% of reserves in central banks. In the 2010s, it fell as far as 10%. So before we even talk about why now, let's talk about what happened then. So in 1971, we went off the gold standard. And at first, everyone thought the dollar was going to collapse. And everyone ran to even more gold. Central banks had a ton of gold, but they ran to even more. Gold was about 75% of the balance sheets. But what happened was, because our currency was not tied to gold anymore, it allowed the massive creation of this debt bubble that we're in today to really kick off. And every asset that had cash flows that could be monetized was monetized. Every house, only 20% down. Every business purchased leverage buyouts, this and that. Like everything was margined that could be margined or put on cash flow. And at first, when you don't have a lot of debt, adding debt to a business or country actually adds GDP growth, actually adds to earnings and revenues. But at a certain point, when you have too much debt and you can only grow by adding more debt, that additional layer of debt really isn't moving the needle on the growth side. We see it with stimulus as well from quantitative easing. When we were in COVID, the government was literally sending people checks. Like to a certain point, it helps. And then after a certain point, each dollar has less beneficial factor to like actually generating that stimulus and that growth. And the same thing has happened in the debt market. So what ended up happening at first when we went off the gold standard is everything that could be monetized with debt was monetized with debt, and anything that couldn't be monetized with debt went down. And that included gold and other precious metals. You can't really monetize with cash flow a pile of gold and put 5-to-1 leverage on it. No one would have given you those terms. So gold did really poorly, and everything and gold just started falling in terms of how much central banks held them as reserves, and they got down to the low 10% in the 2010s. And then the U.S. continued its quantitative easing, buying our own assets, buying our own debt, and you started to see towards the end of 2010 into 2020s that number start to pick up. And now we're at about 25%. So 25% of central banks' balance sheets are currently in gold. And that number looks to be rising at just an asymmetric pace, just kind of up and to the right. And you can see that on one of our charts in the why gold now space. So I like to say, well, what do they know? They're selling dollar-based assets. They're selling U.S. government debt in exchange, just buying as much gold as they can find. There are rumors that no gold is coming out of Russia because Russia just buys all the gold that's mined from their miners directly for their own balance sheet, right? It's a run to scarcity of value when everyone can just print and has printed and kind of gotten drunk off their ability to print debt and run massive deficits, even in amazing economic times like now. What's going on right now? Well, almost all assets are all-time high. We are lowering interest rates, and actually we're rolling off of quantitative tightening, which is its own form of quantitative easing, meaning the government's big balance sheet of all these bonds we bought over the last 20 years, they were selling them down. They're not selling them down anymore right now. And so these are measures that you normally see at the bottom of the market. Why is that? Well, the Fed was built to fight corporate and banking greed, not necessarily government greed. They really don't have the tool set to adjust a market that's being driven by too much liquidity from the government, right? And one of their mandates is employment, right? So we see employment fall or start to get a little bit shaky. It gives them reason to lower interest rates. But all of this being, again, while assets are an all-time high, deficits are massive. And, if the market were to pull back and there was a massive equity drawdown and equities are down 50%, Bitcoin would certainly be down during that time period. But what would the response be by the government? Even more printing, even greater deficits. And what does that mean? Well, the value is still in the scarcity. Bitcoin mines less than 1%. Gold mines less than 2%. They will just be printing money to no end, devaluing our dollar, but they can't print more Bitcoin and gold. Right? And that's why we always felt that these two ETF asset classes paired together were the absolute best. Now, on the institutional side, there's a report in that Why Gold Now first chart. Bank family offices ownership of precious metals at the end of 2023. it was less than 1% of their portfolio. They had 22% in private equity that they're trying to get some liquidation on and liquidity and cash flow on. They had 10% in real estate. These are the exact vehicles, by the way, that benefited from that massive debt accumulation, right? When all of a sudden all these small businesses have no debt on it in the private equity world, as interest rates dropping, we're printing money, and they can just buy businesses at lower and lower rates because interest rates just fall for like 30, 40 years. It's a panacea for those markets, right? And you can see why during that time period, people didn't want to own true scarcity assets like gold, because they would say these are non-performing assets in your portfolio. And the old adage story of gold is it's a store of value, but not a wealth creation. And we think that's wrong. We think it was historically just a store of value. Like a house in 1850 would probably cost you the same amount of gold bars as a house in 1950. But that all changed once we went off the gold standard. And it took a couple decades for it to catch back up, because at first that debt accumulation phase was just terrible for gold. But we think that since 1971, gold is an actual real return generating asset, meaning it has a return beyond inflation and not just a protection and a store value, but an actual generator of wealth. And you've seen that here in this last run over the last 25 years.
So I've heard Bitcoin called digital gold before. So can you add to that a little bit?
Yeah. In our opinion, Bitcoin is digital gold and gold is physical Bitcoin. I think, they are slowly being accepted as much more similar assets in your portfolio. When Bitcoin was first introduced into this world, or at least in the ETF world, people, had a correlation in magnitude of movement closer to 3x Qs. But it's been trending more and more with its volatility dropping. So it has less and less beta to the Qs. And it also has been getting a bigger portion of its correlation from things like gold. Like if you look at Silicon Valley Bank, when that happened, worry of questioning the system and the sanctity of our system was not really a thing 6 years ago. And all of a sudden, Silicon Valley Bank, and all of a sudden, massive debt accumulations. The idea of being worried about currency debasement is not something that was on top of mind for most investors, even just 2 years ago. About 12 months ago, we tried to market this as a currency debasement hedge. And at that point, Finner was like, I don't know, actually. And then at this point now, they allow us to do it free and clear, because every major Wall Street firm is going out there saying you have to protect against currency debasement. Here are two potential offerings. And I think one thing I'd love to frame for people who are new to Bitcoin, what is the difference between Bitcoin now and 8 years ago? Well, at one point, the way Bitcoin works, there's 21 million Bitcoin that will ever be mined. Every 4 years, that mining rate gets cut in half. Right now, we're at 86 basis points. The next halving will bring us down to 43 basis points. But at some point, we were mining 15% new Bitcoin every single year. And what that meant was you had to convince the people around you to also like Bitcoin, because Bitcoin was growing at a faster rate than we were printing dollars. And I think a lot of people have reference of what Bitcoin was like in that world. And they don't understand it's a different asset when it's only mining at less than a 1% rate, as we see now. And that's one of the biggest differences between Bitcoin then, Bitcoin now, and also obviously the institutional adoption. We just saw finally in the last 2 months, Morgan Stanley allow their advisors to recommend Bitcoin to their clients. All this, if you were a Morgan Stanley client, your financial advisor was not legally allowed to, on discretion, allocate your assets to Bitcoin. Finally, they just turned on. France just had a motion they're trying to pass, I think it's early days, saying they want to buy 2% of all Bitcoin that will ever be created as a stalwart of their central bank, central bank's balance sheet. Sorry. And, you can just see this. What was a central bank initially designed for to do, or what would a balance sheet be intended for? Really, it was a last resort, meaning if your currency was eroding fastly and all of a sudden your economy is in shambles, your central bank has a balance sheet so that in last resort, you can facilitate trade, specifically with the countries that you buy energy and agriculture for. Irregardless of how bad your financial situation was as an economy, your government could always go out there and buy energy and food to keep you warm and keep you fed. And that made a whole lot of sense. And now they're saying, we don't want to do that anymore. Those currencies are terrible. Let's buy more gold. That's literally what they're doing now. And so what do they know? And why aren't more people following their lead? And every time gold has like a 3 month or 3 week, 3 month sideways period, everyone's like, oh, it's over. And that makes me so bullish because it's like, well, tomorrow they're going to keep printing dollars and we're going to find less gold than we will find dollars, new dollars in this economy. And so this time is different. To quote a very amazing economist I love to follow, Lynn Alden, nothing stops this train. It's a quote from Breaking Bad. It's a joke, but it's also not a joke. And it's also very sad. People sometimes ask me, it's like, well, you basically seem to allude that there is no long-term bear case for Bitcoin and gold. It's sad. I don't believe there is. The one was the Doge Task Force. And we were talking about this last year when we first launched the fund. If the Doge Task Force was actually able to clean up our deficits in our balance sheet, I think that would actually be bad for Bitcoin and gold. But the way our political systems is set up, that just, if we couldn't have done it in the last 12 months, it seems unlikely we'll be able to do it in the future. Our political cycles are 2 and 4 years long. So you have to rerun every 12 to 24 months, halfway through your cycle. And it's really hard for people to put into place anything that takes a long time to actually show its benefits. And, no politician ever got elected, turned to its constituents and said, I'm going to fix all your problems by taking away all your funding. Reelect me in 24 months, please. That just doesn't really happen in our world, which is sad. It's not a joking matter. It is actually very, very sad. But the government at one point went from, let's do a Doge Task Force, let's clean up our deficits. Oh my gosh, this is not possible. To now, let's grow our way out of these deficits. And that means baseline inflation will be closer to 3%. And we hope that comes with a lot of productivity and GDP growth from AI. That as long as we have more growth than AI, than inflation, our debt will just kind of erode. But that's a whole lot of printing that gets us there. When I'm referencing here 2 assets that can't be printed by the U.S. government or any other government.
So if this fund is intended for somebody who's bullish on Bitcoin, is that fair to say?
Yeah, honestly, bullish on both, or especially at the very least, how these 2 assets counteract with each other and the uncorrelated nature of these 2 assets between the 2.
Yeah, when I've looked online before, I see huge predictions for Bitcoin. Do you have anything to add to that?
We think over time it will continue to get a lot higher. I think there's going to be lots of bouts of volatility. We are very bullish on the short run, but overall, what I would say is you should look at this as an asset that you want in your asset allocation mix for the next 10, 20, 30 years of your life. So just start thinking about what is a long-term asset allocation that makes sense for you. As you said, this is not financial advice. Everyone has their own perspective. But within that, we think this is a great tool to take a portion of both your Bitcoin and your gold allocation in a capital efficient way. We're calling it basically return stacking 2 different returns on top of each other. I like to say stacking the returns and not necessarily stacking the entirety of the risk, because the risk isn't the risk of one plus the risk of the other. The correlation benefits really benefit in that sense, and the rebalancing really adds a lot of value to minimize some of that volatility as opposed to just owning the 2 independently.
So the ticker for this fund is BTGD. And where can people find out more about this at?
Absolutely. You can find us on quantifyfunds.com, Quantify Funds on X, on Instagram, or any real platform there. My name is David Dziekanski. You can find me on Twitter as well. We have a couple new funds launching right before the end of the year, after Christmas. It's more in the income space. So more to come on that side, but we'll have what we like to say is even closer into the realm of hedge fund like offerings in the ETF vehicle. That's always been my dream. It means the products are quite complex. You can't necessarily just like hear an elevator pitch for 10 seconds and be like, oh, I know what that does. And I think that's awesome. It's a little bit of leap of faith that the individual investor world is willing to actually do this level of due diligence and assess is this a fund that's worthy of my time and allocation or not. But I think you guys as a whole have done an amazing job at that. And because of how collaborative your investment process are across all of these individuals. Your knowledge adoption curve has been so strong that we're really excited to push the needle even further and launch what true income style crypto hedge funds in an ETF. And I say hedge fund just because of the complexity, not because of the crazy performance fees. There's no performance fees in an ETF. The ETF is the most democratized vehicle in the world. You don't need to, be an accredited investor to invest in an ETF. On most of these platforms, you can even do fractional shares. You can buy a half a share of an ETF, put $5-10 into an ETF. And we're just really excited to launch true hedge fund like ETFs in, again, late December, right after Christmas, in the income space, fixing a lot of the problems that we see out there today. So, Michael, I'd love to be a guest on your show as soon as our information becomes effective, which should be right around right before Christmas. And once we cross that effective date, we can go into much greater detail on these new funds.
Well, I'm definitely excited about the new funds coming out from you, and I would definitely love to have you back on the channel. I learned a lot from this, a lot of things I didn't know, and I appreciate having you on the channel. Do you have anything else you'd like to add?
No, I appreciate you. Thank you for your time. It's Sunday morning, and Michael's building his channel here around his everyone's crazy schedule, and so we're all entrepreneurs. And I appreciate your time and asking me to be on your show. And I love what you're doing, and I'm excited to see your content grow.
Thank you for coming on to the channel, and everybody. Until next time, I'll catch you all later.
Thank you.